Hey folks, welcome back to the channel. It's Liquid here, and we're going to talk about the Canadian dollar today. It has fallen to a 2-year low at 0.71 compared to the US dollar. And the reason this is important is because the Canadian dollar affects everything we buy, from groceries to cars to housing. And because we live in a global economy, how much our currency is worth is going to affect our standard of living. Maybe not immediately, but definitely down the line. So the last time we were at this low was back in 2022. And I'm thinking that right now, because it fell below so many support lines over the last 2 years, that it could very easily fall below its current price right now. And then the next target is going to be sub 0.7. So you're looking at like 6.9 or even 6.8, back to the previous point where it went in the last recession in 2020. If you look at the rough formation on the weekly chart, which is what we're looking at, there's a clear trend of resistance where it's heading down, where each time the Canadian dollar went up, it went up just a little bit lower than the previous time. Meanwhile, at the bottom, we have this rough support line over here, forming this descending triangle. And if this breaks out to the bottom, then watch out below. So why is this happening, and what should you do about it, if anything? Well, over the last couple of months, it's been pretty clear that the Canadian economy is not doing too well. The unemployment rate continues to rise. We're at a multi-year high on a 3-month rolling basis. GDP per capita has continued to go down for like 2 years now, and our immigration policy has completely reversed, whereas before we're letting in like 1 million people a year, increasing the population by 3%. And compared to that, the federal government is now practically not letting anyone in because they want governments at the local level to catch up on infrastructure and social services to absorb all the new demand that we already have. Meanwhile, in the US, you have Donald back in the office, promising deregulation, continue the tax cuts, boost the economy. He wants to end the Ukraine war and not continue to spend billions of US dollars on it. All of these things are bullish for economic growth in the United States, which is part of the reason why you're seeing this large run-up in the stock market in the last week. So you have Canada, which is not doing so well and is probably going to get worse before things get better. And then you have the US, which will likely go from somewhat of a soft landing to more growth. And when you have a divergence in the economy, you also have a widening between the two countries' currencies, because the value of the currency comes from how productive people are from the country that uses that currency. So short to medium term, what that means is Canadians, if they haven't done so already, should be holding some productive American assets like US stocks. And although the S&P 500 is relatively expensive by historical measures, there's no sign of the US stock market or its economy slowing down anytime soon, at least compared to Canada. So you can buy the S&P 500, which is the ETF SPY. You can also buy IWM, which is the Russell 2000. This will likely catch up to the S&P 500 and continue its movement upwards as well in this channel. Here is the weekly chart, and it's near its all-time high. In a few months, there's a good chance it's going to continue going higher, moving above its previous high back in 21. US bonds are also a good place to put your money in. Just be sure to keep the maturity fairly short, like 2 to 3 years at most, because there is risk in the longer term bonds like the 10-year or the 20-year. If we look at TLT, for example, although it has been doing fairly okay and chopping a lot this year, we don't know if it's bottomed yet, because if it breaks down from this wedge, falling below this black line here, then it could go back into the 80s, retesting the 88 level and then ultimately the 82 level if it falls even further. So as the Canadian economy weakens and as the Bank of Canada cuts the interest rate more than the US Fed, I think it would be beneficial to have more of a portfolio exposed to outside of the country, particularly to US assets. Now, at some point, the divergence will be too much and Canada would have to find some common ground with the US interest rate, because the two economies do affect each other. But at least for now, according to the Bank of Canada, we can still go our separate ways for quite a bit more before we have to think about whether we've diverged too much. Here's Carolyn Rogers from the BOC.
You know, there's been a bit of worry recently about divergence, but, there's a limit to that divergence. I don't think we're anywhere near that limit now. Over the years, we have seen rates between Canada and US diverge quite a bit more than they are now. So we'll see.
So I think Canada and the US will go into a recession. Canada most likely will get there first, and because of that, any new stocks I'm buying will be in the US, but eventually I will have to rebalance because Canada imports a lot of things, and most of that is from the US. So when we import like food and gasoline, because our dollar is getting lower, that's going to be more expensive for us to buy those things, and inflation is going to come back in the form of a depreciating currency relative to other countries, and we may even see rate increases in Canada to try to keep a lid on increasing consumer prices. But I think that's going to be at least a year from now or later, and not something we have to worry about right now, as the bigger immediate concern is a recession in Canada and possibly deflation. So that's just my 2 cents for now. The momentum for the US market continues to stay strong, so prices will likely go higher over the next couple of months to finish the year pretty strong. If we do see any kind of major pullback in the stock market, it would likely be in 2025. As always, follow the price action, and I would continue to remain bullish or neutral until the moving averages start to go down. So thanks a lot for watching. Good luck, everyone, and I'll talk to you in the next one.